Cryptocurrencies. Bitcoin. Lesson 5. What are the risks involved in Bitcoin trading? Historically speaking, few, if any, asset classes have outperformed the stock market over the long term. Including dividend reinvestment and inflation, the stock market has returned an average of 7% annually. It's run circles around other assets like gold, bonds, oil, and even home prices. But 2017 has been a year like no other. It has introduced the world loud and clear to cryptocurrencies. When the year began, the aggregate market cap of all digital currencies combined equaled just $17.7 billion. As of late, the aggregate value of these cryptocurrencies soared past $225 billion. This represents almost a 1,200% return in less than 11 months, which the broad-based S&P 500 has taken decades to accomplish. Leading the charge is the most popular virtual currency, Bitcoin. The original cryptocurrency began the year under $970 per coin, and as of December 14, 2017, is standing at around the $16,500 mark. But this isn't to say Bitcoin is without risks. In a span of just 5 months, Bitcoin has endured 3 bear market-like crashes of 38%, 40%, and 29% respectively. In no particular order, the following 6 risks could derail the most popular virtual currency in the world. Firstly, Bitcoin's blockchain could lose its appeal. The real value with cryptocurrencies lies with their blockchains. At the beginning of August, following a soft fork that saw Bitcoin separate into 2 separate currencies, Bitcoin and Bitcoin Cash, Bitcoin's blockchain was upgraded. This upgrade moved some information off of Bitcoin's blockchain in order to boost capacity and transaction settlement times, as well as reduce transaction fees in an effort to attract enterprises. But what if Bitcoin's blockchain fails to be the go-to option for businesses? Right now, more than 150 organizations are currently testing a version of Ethereum's blockchain, which supports smart contracts. These are protocols that help facilitate, verify, and enforce the negotiation of a contract, and they provide marked distinction from Bitcoin's blockchain. If Bitcoin's blockchain fails to differentiate itself and attract enterprises, Bitcoin's price could suffer. Another possibility is that brand name businesses could stop accepting Bitcoin. Since 2014, a handful of brand name businesses have accepted Bitcoin as a form of payment, with smaller merchants latching in recent years. Some investors view this growth in Bitcoin's payment platform as a good reason to buy. However, it could also be a source of investor frustration. If Bitcoin remains volatile, there's the real possibility that merchants could bow out of accepting the virtual currency. A potentially lengthy settlement period gives Bitcoin time to move against the grain, which could mean converting Bitcoin into a lot less cash than when a transaction was completed. If brand name merchants bail on the virtual currency, Bitcoin's price could tumble. Next, there's the double-edged sword of regulation. In some ways, the regulatory environment for Bitcoin has been a positive in 2017. Japan began accepting the currency as legal tender earlier this year, and the CME Group, operator of the world's biggest derivatives marketplace, started carrying Bitcoin futures. These moves helped validate Bitcoin as an investment and a form of tender. Then again, the regulatory environment can also keep Bitcoin out of lucrative markets. In September, both China and South Korea nixed initial coin offerings, with China going a step further and announcing the eventual closure of domestic cryptocurrency exchanges. Increased regulation could either help or hinder Bitcoin. Another possible threat is a cyber attack aimed at Bitfinex or another cryptocurrency exchange. This is a threat to all cryptocurrencies. During 2013, Mt. Gox, which was handling about 70% of Bitcoin's trading volume at the time, was hit by a crippling cyber attack. In the bankruptcy filing from Mt. Gox, just months later, it cited the theft of 850,000 Bitcoin, which are worth $6.8 billion today. In the 2 years following the cyber attack, Bitcoin wound up losing more than 80% of its value. Today, cryptocurrency exchange Bitfinex handles around half of all trading volume for Bitcoin. If it were to be hit with a cyber attack, it could destabilize the market and send Bitcoin significantly lower. The recent development with the CME Group listing futures for Bitcoin was viewed positively by many on Wall Street. The ability for Wall Street firms to take a stake in Bitcoin without having to dabble in decentralized cryptocurrency exchanges could introduce new money and reduce volatility. However, there's another side to the story. Futures trading will allow Wall Street to bet against Bitcoin for the first time ever. It will also allow all walks of investors to borrow on margin to enter those short positions. If Bitcoin's value were to swing violently up or down, it could lead to a flood of margin calls that have the potential to destabilize the market for Bitcoin. And because there's no precedent for an asset like Bitcoin, selling the margin limits is nothing more than guesswork at this point. Last but not least, investor sentiment, which has been a crucial catalyst of Bitcoin's growth, could also push this virtual currency downward. Since Bitcoin's inception, individual investors have controlled its value. Compared to Wall Street investment firms, retail investors are far more prone to allowing their emotions to influence their investing decisions, which rarely ends well. Many of Bitcoin's wild price swings owe to retail investors piling into or bailing out of Bitcoin based on the latest news. It wouldn't take much for investors' sentiment to shift and send Bitcoin's value plummeting.